I think people should look, when they look at AI, try to find companies that actually fundamentally benefit from AI and focus less on what the top companies in the index are.
Thanks everyone for joining us. We're with another episode of Money in the Bank with Frank. Today we've got Byron Fields and Austin Graff, two institutional money managers with similar likes and similar thoughts as me, but I figured we'd kick it off and talk a little bit about the markets, about active management versus passive management, and kind of all the craziness that's going on in general right now in the markets. Thanks for coming in, guys.
Yeah, thanks for having us. So I'm Byron Fields, founder and co-CIO at Titleist Asset Management. Founded Titleist back in 2003, about 10 years before the RIA space really took off. FINRA actually didn't even exist back then. Really, the entire premise behind it was after working at a few of the bigger wirehouses, realized that there was a better way to run money, and a way to run money that was aligned with the clients and in a fiduciary capacity, and that seemed like the right model. And it's been a great 20-year ride.
So far, so good. How about you, Austin?
Yeah, thanks for having us, Frank. So I'm also co-CIO at Titleist Asset Management and CIO at Opal Capital. At Opal, we're primarily focused on investing in dividend-paying equities with a differentiated process, and the fact that we own relatively concentrated portfolios with 25 to 35 names. We do forward-looking analysis, so kind of differentiated from some of the backwards-looking passive options. We're looking for companies that are growing fundamentals while also paying attractive dividends and growing those dividends over time. And then the final kind of differentiator for us is that we're benchmark agnostic, so we're not just kind of following around the benchmarks over time, which is what a lot of the passive options that we'll probably discuss later tend to do.
Yeah, that's good to point out. There's one of the things that really drove me nuts in the very beginning of the ETF markets. Like, I don't know if a lot of people know this, but ETFs were originally just like a part-time holding place for people like you that were active managers back in the day. And it's like, well, if I have, $1 billion sitting in cash from deposits, how do I deploy that quickly? I don't have time. So let's just stick it in like a note that like mimics the S&P 500. But then you get style drift, right? In mutual funds, it's like you think you're in a large cap growth fund and you look at the holdings and it's like the Russell 2000, So that's not what you want either, right? I mean, that's what we're supposed to do, is help them fix that or figure that out. So it is interesting that whole part of the industry has really changed and become very applicable to individual investors, right?
Yeah, I think one of the biggest changes in kind of the ETF space is it went from being a passive vehicle where people were just replicating indices or replicating some corner of the market to now you're getting some active managers involved. And from the active standpoint, historically active management has been focused in kind of the mutual fund space, but ETFs are just a better vehicle. They provide more transparency in most cases, so investors can see on a consistent basis exactly what's in the portfolio. They provide tax advantages because there's just a preferential tax structure for the ETF vehicle. And then finally, there's more liquidity. Mutual funds can only be traded essentially once a day, and the price is pretty much dictated by the manager, whereas an ETF is traded throughout the day with market makers determining the price based on the underlying portfolio. So you definitely get a better deal with ETFs. It's just been a relatively slow transition as many incumbents continue to kind of operate in the mutual fund space.
I think it's interesting, and I'd love both of your takes on, as I mentioned a little earlier, like the indexes themselves have been, now they've got on Wall Street, we love our isms, right? And so now you've got the 7 stocks, the 7 greatest stocks in the world holding up the S&P 500. Well, that's not the way an index is supposed to work, I don't think.
No, that's so a lot of people historically have gotten their market exposure via thinking, okay, I'm going to buy this large passive index that's going to give me diversification. Right now, the top 5 stocks in the S&P 500 account for over 25% of the index. Microsoft and Apple alone are almost 15% of the index. And both of those stocks are trading at the high end of historical valuation. So I'm not sure that investors truly appreciate the lack of diversification in the S&P 500 as it stands now. Being a cap weighted index, it's basically the world's largest momentum fund, right? So when those top names are working, it can carry the rest of the names under it. But when they're not, as we saw in 2022, it can really hurt you.
No, we're hearing more and more about breadth of the market, and we understand that the idea behind that these 7 stocks and these 7 pillars shouldn't be supporting the entire market. Now, the bulls are saying that the rest of those will actually catch up to the ones that we have, and then some people are saying that those 7, probably due to multiple compression, will probably come in and hurt the index, and that's going to hurt all the smaller companies even more. But then we have AI thrown in, which makes everything confusing. What are your thoughts both on the actual breadth of the market issue? Do you have any thoughts?
Yeah, so I have several charts that I could find, but one of the
And
more
we'll throw those up there right now for those of you in post-production. So if you have those to send over, please. Yeah,
we'll do. But breadth right now is actually the worst that we've seen since 2005. We have seen a rotation into small caps over the past, I would say, 5 or 6 market days, which is a healthy development for sure. However, breadth and aggregate is about as bad as it's ever been.
Okay. And what about you, Austin? What do you think on this topic?
Yeah, I think breadth is definitely an issue. And AI and breadth, I think, are different issues in the market today, because AI didn't become as much of a buzzword until kind of halfway through last quarter. It became a big deal towards the end of last month as NVIDIA came out with some really bullish kind of fundamental drivers for their business, and people started to realize that that was rolling through the market. Not all of the 7 are actually AI plays. And in some cases, they might say a lot about AI, but AI is actually hurting fundamentals as they're investing a lot of money to try to get up to speed. However, the margins are much worse on that business that's growing quickly. So it's a bit of people need to differentiate a little bit beyond like, hey, these 7 companies are going to drive kind of market gains forever, and what is AI? I think people should when they look at AI, try to find companies that actually fundamentally benefit from AI, and focus less on what the top companies in the index are. One of the things we've seen a lot of more recently, as you've seen these 7 companies become big drivers, and Byron kind of alluded to this with what we saw last year, is you see the names that are driving returns on the way up also driving returns on the way down. And many supposed active managers are holding significant weights in these names because they feel that's the best way for them to perform with the index or outperform the index in the short term. However, last year we saw a number of those investors also underperformed in the short term when the market went down. So it's kind of a unique time right now because you can identify which active managers are essentially just playing the short-term game, trying to keep up with the market by owning a couple of like names that seem to have a lot of momentum behind them, rather than owning, names that people feel are going to be good investments for the longer term. But I think it's really important for people in thinking about the, I guess, Magnificent 7 is what they're calling them today. Thinking about the Magnificent 7 versus AI and what are the true drivers of AI. It could be a trend that lasts for quite a while, but if you want to play that, you should own the companies that fundamentally benefit from AI, not just get excited about the hype that's going into, whatever it be, a conference call or whatever. So it requires some digging into fundamentals and figuring out what's really going on underneath the hood.
I'd like to point out for those people who are excited about those isms, not every one of those Magnificent 7 made it out alive. So I was watching Stanley Druckenmiller this morning on Bloomberg, and he mentioned, his time at Soros and how he was absolutely right. but not in time. And he had a $200 million bet that ended up costing him $600 million in because he was short. And the market can run longer than we can be right, in a lot of cases. And nothing points more to this than like back to 1999 and 2000, when I kind of was first cutting my teeth in New York. There was all that hype, and there was a lot of change, and there was a lot of things that were happening. And as time went on, of course, everything got better. But there was a lot of companies that blew up. And I kind of feel like since then to now, there's been so much stimulus in the marketplace with so much money chasing all this stuff that people don't remember the time before that, which was when fundamentals mattered. And I still feel like fundamentals should matter. And I don't know when they're going to revert to where they do matter. Do you guys have any thoughts on that process?
I do. So I don't know if 99 is the best proxy. I think for the Nasdaq in aggregate, it's comprised of arguably the best, most profitable companies the world has ever seen. Whereas back then, it was mainly comprised of unprofitable companies without a clear direction to profitability. I think the ARK fund is actually a better proxy for what happened in '99. And interestingly, if you were to take the Nasdaq back when it peaked to trough, it was down 80%, and that's about what ARK was down. And it's also important to note that the ARK fund peaked in February of 2021.
Mm-hmm.
So there's been a lot of things kind of going under the hood of the market, and with tech in particular. So there are some similarities to 99. However, I think the companies that make up what we'll call the Magnificent Seven are phenomenal companies. They're just trading at really high valuations historically. It's also interesting, even if you take, like, let's just say Apple's market cap, it's bigger than the entire London FTSE in aggregate. It's bigger than the entire Paris CAC in aggregate, and it's bigger than the entire German DAX in aggregate. It's also bigger than the Russell 2000. So the trees can't grow to the sky, right? And so Apple approaching on a 3 trillion market cap, I think investors need to ask themselves, like, what is a fair price to pay for future earnings, and what is kind of viable going forward? And Apple trading at 30 times forward with negative year-over-year earnings, that's tough to make sense of.
Yeah, I think that the Nifty 50 from back in the 70s is another kind of good comparison, as there were a number of companies at that time where people, I mean, they were called one decision stocks. You just had to buy them and hold them forever, right? Xerox was one of them, right? But they were a great innovator in the 70s, and then they lost that kind of innovation bug, and now it doesn't really exist. And so there were a number of companies at that time frame that people viewed as being, the next driver of innovation and the future of society. And that was true for a period of time. And then, the market kind of evolves and things happen, and some of the incumbents adopt some of these technologies. Some new players come in. So it's just hard to, I think, over the longer term, assume that these 12 companies are going to continue to dominate the market forever. However, I don't know what's going to happen to prevent them from dominating them for the foreseeable future. So it's hard to come up with like the counter argument at this point.
One of the things that I find fascinating, talking about risk in general, recently there have been a lot of companies like Apple, like Ford, like GM that have come out with these new savings vehicles that are, it's like cash, but then you look at it closer and it's high yield. And people are feeling that, like, if it's not equity, it could be, it's safe. And what are your thoughts on companies like Apple or Ford for sure that have these high yield savings? It's just like a bank, but it's not insured. What are your thoughts on some of those things that are coming out now?
I think they're a real threat to I think investors are finally, or just savers are finally waking up to the fact that there's a higher yield. We spent 12 or 13 years in a zero interest rate environment. So it didn't matter if you were getting 5 bips in a checking account versus, 50 bips in a short-term treasury or money market or CD or whatever it may be. Last summer it ticks to 2. We saw a little bit of interest. Last fall, 3, a little bit more interest. when they're 4%, now we're at 5% throughout the first 6 months of the US T-bill curve. And people are waking up to the fact that there are other alternatives out there. I don't have to take any credit risk. I don't have to take any duration risk. And it just amazes me still to this day that banks are paying 3.5 to 4% on a CD with the same equivalent maturity as a treasury. So you're sacrificing liquidity and you're getting almost 25% less return. It also amazes me that money market managers are charging 10 or 20 basis points basically to ladder 3 months worth of T-bills.
Mm-hmm.
And so there's other alternatives out there, and we're seeing a lot of investor interest, particularly in corporate accounts where they're sitting and they need, these are operating accounts where they
Sure.
need to be sitting on a lot of cash, but they're finally waking up to the fact that there's yield out there. So I think Apple is doing the investing public a service by doing this, and I don't think that would be risky at all. Arguably, Apple's balance sheet is stronger than the United States government. So
Right.
There's kind of two things to think about when you think about those situations. One, I think Apple, if you read in the journal last week, or maybe it was earlier this week, some clients or customers are upset because they can't get their money back. I think that actually Goldman Sachs does some of the back office there, and they're having a hard time. Actually, like if a customer wants, liquidity to buy a house or whatever, operationally, they haven't been able to get the money back, which I don't think that's necessarily a good thing. I don't know that there's an issue with that from a kind of funding perspective. But I think more broadly, when you think about it, how does this impact society and the economy? The Fed, in raising rates, has been trying to essentially tighten financial or monetary policy by reducing the amount of cash that's flowing through the economy. And as we see banks, they call it deposit beta. So they aren't raising deposit pricing as quickly as the Fed is raising interest rates. And deposit betas have been at historic lows. So basically, people are either too lazy to move their money or they just don't care. And by leaving that money in the banks at extremely low rates, it's providing more liquidity to society than what the Fed really wants there to be in circulation. And so we need to find that gap needs to close in order for us to kind of right size the economic, I would say, drivers or the fuel that's driving the economy today. And as that gap right sizes, I think some of the people that are going to be, or some of the companies that are going to be hurt by this are the regional banks, because regional banks essentially borrow short and lend long. Mm-hmm. And a lot of their longer term lending is fixed for a period of time. Mm-hmm. So if their borrowings become more expensive, the spread between what they make and what they borrow at becomes smaller, and ultimately could go negative, which is a really bad thing for regional banks. And that kind of filters through the rest of the economy, because many regional banks are the financing mechanism for small and medium-sized businesses. Mm-hmm. So as we see some of these changes kind of rolling through the economy, they're not happening overnight, but we can see a path to where things could get much more difficult mm-hmm. for many Main Street companies and many people on Main Street than what it probably is right now.
And Frank, just to quantify that, so small and regional banks, I think the United States, and I'll send you this chart so you can post it later too. The United States is the envy of the world with regard to our banking system. I want to say that we have over 4,000 small and regional banks, where the next closest developed economy in the world only has 300. And with regards to credit creation, small and regional banks account for over 50% of all credit creation, and the overwhelming majority of credit creation for small business, which hires multitudes more people than big business. People think that the Fortune 500 are kind of the main drivers of employment, and that's not the case at all. And there are very few things that you can say with almost certainty in this business, and it's an almost certainty that credit conditions are going to tighten to a degree that we haven't seen in a long time. And so with the banks, when you have this degree of deposit outflows, coupled with a balance sheet that's sitting on a lot of fixed income that was bought prior to this, brutal rate hiking cycle, credit conditions are going to tighten. Not to mention these banks are sitting on a lot of assets or a lot of loans on assets, in particular, commercial real estate that are going to be problematic in the years to come. So I think that's going to have profound implications on the economy in the foreseeable future.
I'm curious, and Byron, you might be the one that is able to look this up fairly quickly, but we've got the Fed that's tightening, right? We've got the Fed raising rates. They're taking in money, issuing fixed income. You've got the Treasury building back. You've got the Fed doing the same thing. You've got student loan moratorium going away. The people that tend to spend the most frivolously are the people that don't realize how important it is to have savings, right? And so they've been spending on Amazon and all these things. So you've got people, as you guys mentioned, more money chasing fewer goods. Now we've got less money still used to spending money, which we know that doesn't always end well. And then again, taking a look back at that 20-year cycle from pre-1999 when people knew that you could make 5% or 3%, be realistic, 3% in a bank account. So I think there's a little bit of that laziness factor because people are, as you said, just starting to realize that they could actually make money, and why isn't my bank paying me enough? Now, we know that banks only make money one way. They make money one way. They loan money, right? But the big banks don't loan money to small businesses at all, right? They tend to lend money to big businesses, and it's the smaller and regional banks that facilitate growth as a relationship-based institution. And those are the ones that are, as you mentioned, the ones that are going to get hurt or are getting hurt. And by virtue of that, we're all getting hurt. Right?
They're impaired to a degree we haven't seen in over a decade.
So what do you think is a reasonable path? What do you, if you were looking in your crystal ball, how do you see the path of least resistance on this kind of topic?
Yeah, there are reports that there's an additional kind of $500 billion sitting in consumer checking and savings accounts right now, in excess of what was there in kind of 2019. And that's kind of the tail of stimulus. And it's not even. Obviously, some folks kind of work through their stimulus relatively quickly, don't have any left. And then some people have, all of the stimulus that they receive sitting in an account, and they're never going to spend it. But the reports are, they think that that's going to burn off sometime towards the end of the third quarter to the end of the fourth quarter in 2023. And these are I think the two biggest banks in the country, Bank of America and JP Morgan, both have similar estimates as to when that excess kind of in savings and checking accounts will wear off. And I think when that happens, then we're going to see the true impact of the tightening that has taken place over the last 12 to 18 months. On top of that, for the last 5 months, we've had the Fed trying to tighten monetary policy while the Treasury has been essentially loosening monetary policy because they've been spending down their general account without issuing any more bonds or raising taxes to refill it. So there's the expectation that tightening will resume in the coming days, not even the coming weeks. And that might change kind of how much money is flowing through the economy. So it's really hard with these macro factors to figure out exactly when things are going to happen, but we can see the trends and we can see what's kind of lining up to potentially being an issue in the back half of 2023.
It's also interesting, if you were to look at Fed fund futures, just a month ago, they were discounting a high probability of cuts the back half of this year. There was actually at one point about, I guess, 3 weeks ago where there was a 30% chance of a 25 basis point cut in July. Obviously, that's been completely priced out, and basically all the cuts that were priced in or discounted in Fed fund futures have now been taken out. So it's surprising to me to see the market respond in the way that it has over the last 2 weeks in the face of what is going to be a higher for longer kind of situation as far as Fed fund futures are discounting.
Yeah, if you want to walk through kind of how that should work, it seems like if you're going to have interest rates higher for longer, people should start thinking about valuations again, similar to how people saw investing in kind of the mid 2000s, right? And quite frankly, through the first 6 months of this year, people threw valuation to the wind, right? They just are jumping on the index and pushing up, making expensive large cap names even more expensive, and in many cases making inexpensive smaller names that still have good businesses even less expensive. So it's a relatively unique opportunity. It's kind of hard before the fact to understand what's driving these things, but it seems like we're starting to kind of peel back some of the leaves here and identify some of the issues that have been driving the market. And it seems like we might be in for a change here in the coming days to weeks.
So buy water and tobacco and
Utilities. Yeah.
yeah. So what are some of your favorite industries, if you will, Austin? I know that your Divs fund tends to do, dividend growing, dividend paying fund individual companies. What do you look at? What are your screeners?
Yeah, so we manage DIVZ. It's a low volatility equity income fund. And so by nature, we're looking for companies that have resilient business models through the cycle, have significant free cash flow generation, and like to distribute that free cash flow to investors in the form of an attractive yield today that's also growing over time. And so with that framework in mind, currently, as we see the economy kind of struggling, we're looking for names that can perform well and generate a lot of cash in a kind of a hairy economic environment. So currently, we like regulated electric utilities. We think that they're a great play right now because a lot of them have exposure to hardening of the electric grid due to ESG. So as we consume more energy through electricity, and think about electric vehicles, people don't go to the gas pump. They're actually filling up their cars, and the electricity has to get to the car somehow. And so more money needs to go into the electric grid to make it stronger, more resilient, make it transport more electricity. And the regulated electric utilities are going to be the direct beneficiary from those investments. We also currently, we like some healthcare names. We think healthcare will perform really well regardless of what happens in the economy. And we like oil and gas, quite frankly. And that has to do with the fact that we've seen a unique supply and demand picture in the oil and gas patch recently, where companies have underinvested in new supply, and demand isn't falling off nearly as quickly as many people expect. We think that petroleum is going to be a source of energy for an extended period of time. We're not just going to convert the economy from a fossil fuel based driven economy to a purely green energy driven economy overnight. It's likely to take decades. And many of the current assumptions and forecasts assume that essentially the transition happens in the next 5 to 10 years. It's unrealistic. And those unrealistic assumptions make many of the oil and gas companies extremely cheap. At the same time, these companies have gotten religion on capital allocation, and so they're distributing a significant amount of free cash flow to investors in the form of dividends and buybacks, which we think is good for shareholder returns over an extended period of time.
When you talk about healthcare, are you talking about the pharma companies? Are you talking about the hospitals? Are you talking about just the whole shebang, because people tend to pay for no matter what it is they're going to pay to stay alive? Or is it any specific sector within there?
We own kind of all the above. A lot of it has to do with the baby boomers. So you have the largest generation of our society is getting older, and they're all consuming more healthcare, whether that be through pharmaceuticals as people age and get to retirement years. They just naturally end up consuming more pharma products. Whether that be through, we own a company that focuses on medical devices, whether that be through pacemakers or new joints. There's a lot of demand that should be growing, just as you have an aging population. And then we own some of the health insurers, as you have compulsive health insurance in this country, and many people are moving to Medicare and Medicaid as they get older from their employer policies. There are some there are some health insurers that have tremendous tailwinds in the current environment. So we think that there are opportunities across the board. There have been some headwinds. So the Inflation Reduction Act last year was somewhat combative to pharma companies. And yesterday, actually, Merck sued the US government for trying to set prices at below market levels. It'll be interesting to see how that shakes out, but it does kind of highlight how there has been some, I would say the current administration has been somewhat combative to some of the pharma companies, creating a short-term headwind. However, that's created a pretty good value opportunity to get into some names that have some significant free cash flow generation and pay really nice dividends with the expectation of doing so, even if the economy kind of struggles from here.
Yeah, I agree with some part of that. I do think that is making it attractive because we know that health insurance companies know just when we're going to die as a population. And so they've got the math down pat. Yeah, they know how much they're going to make based on those premiums that we're paying, right?
There's a really interesting trend right now. And so one of the things that the big health insurers are doing is they're focusing on outcomes. Rather than just waiting until you get sick and saying, okay, Frank, you have like such and such disease, here's some medicine, go home and take care of it. They're saying, Frank, why don't you come in before you have an issue? Let's talk about how we manage your diet. Let's talk about exercise. Let's talk about preventing you from getting to a place where we have to go spend a ton of money on pharmaceuticals, on operations, on live-in care, or whatever it is to deal with a problem that may have been preventable. And so that's actually improving outcomes for consumers while also improving margins for the health insurers, right? Yeah. Because they aren't necessarily having to pay as much for each insured life as they had in the past. And as they can reduce that cost, it improves their margins. So it's a really unique space with a lot of moving parts. And we think it's relatively attractive, especially for, innovative companies who are willing to go out and kind of find the new ways of doing business.
Yeah, that's great. It's interesting because I kind of see in healthcare a shift to kind of what we understood as independent financial advisors was that, like, you're in it to keep your clients having more money for the right reasons, because the more money they have, the more money you make, right? And I see that that's happening in the healthcare space, using apps and trying to get people to do more things that will keep them alive without having, granted, we have Ozempic, which means you can eat whatever you want now. But before that, it was like, let's try to focus on the things that are going to keep you out, from snoring and keep you from having these like migraines and body issues. And I often get to put that on an equal footing. I often get a phone, questions where people ask me, well, what do you do that I can't do on an app? And, my answer is usually pretty easy, which is like, your app isn't really going to bother you when you haven't done your estate planning right. Your app is going to, if it does a once up, it's going to say you need to do this stuff, but it's never going to bother you to actually do it in the right way that a human will. So I think that's a positive for the asset management industry, as well as right now, because the banks are not providing enough on the savings route, it's allowing us to point out to our clients that do have companies as well as individual assets just sitting in banks. Your money should be working for you. You need to have, you've got a job, your money needs to have a job. If it's not making at least what inflation is making, it's losing that amount every year. What are your thoughts on that, Byron?
Yeah, I mean, I think at the end of the day, the most important thing that we can do for clients is we're risk managers and make sure that they're allocated appropriately. So as we referenced at the top of the pod, there's a lot of concentration right now in the S&P 500, and we're seeing opportunities in fixed income that we haven't seen since 2007. So when you can get almost 5%, 5.5% on the risk-free side of the ledger, that kind of changes the equation, especially given where valuations are and the economic outlook that we have and that we've been discussing. So I think the single most important thing that we can do for our clients is just make sure that their allocation is proper for their situation, and make sure that they understand kind of the risks associated with it, and just kind of try to navigate through what I think is going to be a difficult next 12 to 36 months.
And Austin, as we've been looking at the long side of the curve, and fixed income is obviously an asset class that people are more interested in now because it seems relevant. Uh, Going back again 15, 20 years when this risk of investment quality risk actually mattered, are there any opportunities, or are there any things that you see out there? Like what are your favorites or dislikes when it comes to fixed income?
Yeah, I think you have to be somewhat careful with fixed income. And a lot of it has to do with, think about real returns, right? And so we still have inflation that's north of 4%. So if you're buying bonds, with a 5% yield, you're assuming that inflation is going to continue to go down. And I think that implicit assumption in many fixed income markets today, many people might not be understanding as well because they haven't had to deal with it for a very long time, right? And people were just fine having negative real returns when interest rates were near zero and inflation was maybe 1%. But should you be interested in that when you recently saw inflation pop up to 7+% for a short period of time? I don't know. So I think that investors need to remain focused on being balanced, and think about what could combat inflation if inflation does pop back up. And so that's when I like dividend paying equities. I've always liked dividend paying equities, but they tend to be an amazing inflation hedge. So when you think about a source of income, many people will say, well, the 10-year is currently above the dividend yield in the S&P 500. So why would you ever buy a dividend paying stock in this environment? And the reason for doing that is because of inflation. Because if inflation pops back up to 5 or 6%, your yield on your dividend paying company has the potential to grow along with inflation versus a bond necessarily seeing capital destruction in the process. So I tend to think that if you're in the fixed income market, stay on the shorter part of the curve because we don't really know what's happening with inflation. If you're going to go out longer on the curve, you definitely need to be cognizant of the fact that you are making an implicit bet that inflation is going to continue to go down.
And
so
that things aren't going to break.
Frank,
And things aren't going to break, right? So we
Right.
want to know that.
So Frank, just to kind of quantify that a little bit. So we'll talk about duration first, but I'd also like to talk about the credit quality component of it. But from a duration perspective, so the Barclays Aggregate Bond Index is the S&P 500 for bonds. Since inception in 1974, and the reason we don't have an index prior to 1974 is that there isn't reliable data on corporate bonds prior to. So if you just want to look at treasuries where we have very reliable data, it was the last year, 2022 was the worst year for treasuries in aggregate in over 200 years. That predates the Civil War. So I think that was a wake-up call for a lot of investors. Unfortunately, a lot of investors, almost all of retail, their investments in fixed income are through mutual funds, where you're not locking in a particular maturity. It's this kind of perpetual duration product that really doesn't make a lot of sense. And so today you have the 10-year trading at 3.6. And so from 1982, rates peaked. We had a 40-year bull market in bonds as rates went from whatever they peaked at 13.5% back then to 0% post-COVID.
Mm-hmm.
And what if we go into a scenario where we're in a rising rate environment for 10 years, 20 years, 30 years, 40 years? These fixed income bond funds are going to lose money every single year in that scenario. So if you buy a 10-year treasury today at 3.6% and 2 years from now it's at 5%, which historically is low anyway, on principal alone, you're going to lose anywhere from 10 to 15% of the value of that security. And if that's the dry powder to reallocate back into equities when the time is right, you're already down so much on that particular side of the fixed income part of the ledger that you don't have the capacity or the willingness to you've already taken a big loss on the side of the portfolio that should be serving as the ballast, right? And as far as credit goes, spreads, whether it be investment grade all the way down to high yield, you're just not getting compensated for that risk. So spreads are still historically tight. And so I agree fully with Austin on the below. I think it makes all the sense in the world to keep duration short in this environment, especially when you're getting a higher yield on the short end of the curve anyway.
Mm-hmm.
So our portfolios on the fixed income side, as far as duration goes, they've probably never been shorter.
Yep.
And as credit risk goes. I mean, we're heavily overweight government bonds.
And what about quality on the muni side? As you know, for those of you that don't know, I like to say there's a couple of different types of retail investors, and those are the get rich camp and then the stay rich camp. And so in the stay rich camp, people that do have money that they want a fixed, reliable income, many of those are invested in the municipal markets. So are there any particular municipalities? And if you haven't done any research and don't know, that's totally fine. You know, I could address it at some point in the future, but are there any municipalities that you worry about? I know back in the day, we were worried about New Jersey all the time. I was worried about
Orange
certain places
County,
in California. Yeah.
Yeah. So I can't recall exactly when the Orange County default occurred, but I'm not an expert on each municipality, but we all kind of know where the zombies lie, Chicago in particular. But fortunately for our investors here in Texas and most states, we can buy munis in any state, whereas, you know, I believe in New York and Illinois and states like that, you're forced to buy the munis of those particular states.
Right.
So
yeah, so that's a quality issue too, you know, figuring out that not only do you have to look at the curve, you also have to look at what you're investing in, whether it's like a revenue bond, which actually gets paid based on what they're actually making, like tollways. We know people are paying their tolls, or general obligations, which tend to be issues. But we'll talk about fixed income on another event. I know that you guys have a day to get back to. If people wanted to follow you, I know, Austin, that you do pretty religious pod on your LinkedIn profile. How do they get in touch with you? And then Byron, the same thing for you.
Yeah, they can reach me. We have a website at opalinvest.com, or you can email me at austin@opalinvest.com. You can also follow Opal Investments on LinkedIn or your favorite kind of social media platform. We post pretty frequently on those sites.
Awesome.
yeah, and I don't have a big social media presence, but feel free to email me at bfields@tamgmt.com, or just find us online at titleistassetmanagement.com. Our Twitter handle is at titleistassetmanagement.com and or at Titleist Asset Management. And yeah, that has all the information about our firm.
Great. Well, it was a pleasure talking to you guys. Hopefully we can do this again, maybe one more time closer to the end of the year together or individually. Reach out and let me know.
Yeah, thanks for having us.
Yeah,
Thanks, Frank.
guys. Everyone, thanks for another episode of Money in the Bank with Frank. I look forward to chatting with you next week. Have a great day.
Hey, thanks for watching The Merge. We've got a ton more stuff for you to watch on YouTube, on Instagram, on TikTok, everywhere. Check us out.